Picture the car park outside any Australian primary school 20 years ago. Same handful of badges on almost every bumper. Familiar names. Brands your parents drove, brands you'd probably drive too. Now, go look at that same car park today. The badges have changed. Quietly, in the space of about 2 years, and most people haven't clocked it yet. This isn't a story about one struggling brand. It's about an entire order getting rewritten at the same time. Trusted, decades-old names losing ground fast, while companies that barely had a showroom in this country 3 years ago are now fighting for the #1 spot outright. If you're planning to buy a car anytime soon, or you already own one from a brand you assumed was untouchable, this matters to you directly. Because when a brand loses momentum, it's never the head office that feels it first. It's the owner, in resale value, in how far you have to drive for a service, in whether parts show up in days or months. I'm going to walk you through exactly which brands are sliding, why it's happening to several of them at once, and the 3 things worth checking before you sign anything. Let's get into it. The brand everyone assumed was safe. Start with the biggest name of all, because if this one is feeling pressure, nothing in this market is safe from it. For more than 2 decades, this brand hasn't just led Australian car sales, it's dominated them. UTs that topped the charts year after year. An SUV lineup that became the default choice for family after family. A name that, if you stopped 100 people on the street and asked them to name any car brand, would be the first word out of most mouths. In the first half of this year, that brand's sales fell more than 20% compared to the same period the year before, a drop in the tens of thousands of vehicles. For a company operating at that scale, that's not statistical noise. That's a serious dent. Here's the detail that actually matters more than the raw percentage, though. In one recent month, a Chinese automaker that most Australians couldn't have named 2 years ago came within a few hundred sales of outselling this giant outright. Not a fluke month either, that challenger had been sitting in second place for months running, growing well over 100% year on year. To be fair to the market leader, it isn't collapsing. It's still comfortably on top, and a wave of new models is coming to shore things up. But when the most dominant brand in the country's history is being chased that closely by a company nobody had heard of a couple of years back, it tells you the old assumptions about this market don't hold anymore. The loyalty brands getting tested now. Let's talk about the brands whose whole identity was built on customer loyalty. Because loyalty, it turns out, isn't the shield people assumed it was. Take the brand that built its entire reputation on all-wheel drive as standard, on being the sensible choice for anyone who actually drove somewhere rough on the weekend. Its buyers weren't just customers, they were repeat believers, generation after generation. In one recent month, that brand posted the steepest decline of any major player in the country, down well over a third. Its bread-and-butter mid-size SUV dropped by roughly a fifth. A smaller model in the range fell by more than half. Some of that is genuinely explainable. A couple of its most important models were mid-changeover, and a bold new design divided its own loyal fanbase. But underneath the timing story sits a bigger structural problem. While the rest of the market raced toward hybrid and electrified options, this brand was slow to follow. That gap left an opening. And buyers who would once have walked straight into that dealership are now cross-shopping a hybrid family SUV or a well-equipped Chinese alternative with a screen the size of a tablet and a warranty that runs twice as long. Then there's the brand that spent years quietly repositioning itself, upmarket. Nicer interiors, sharper handling, prices creeping closer to premium European rivals, chasing a reputation as the smart person's choice. That didn't need a luxury badge to feel like one. That strategy worked for a long time, but raising prices during a cost-of-living squeeze is a dangerous moment to be doing it. Sales for this brand fell close to 14% in the first half of the year, with some of its former chart-topping models down over 30%. As it quietly got more expensive, new entrants came in underneath it, same or more equipment. Meaningfully less money. The lesson in both cases isn't that these are suddenly bad cars. They're not. Reliability hasn't gone anywhere. The lesson is that a loyal customer base can only absorb so much friction. whether that's being late to a technology shift or getting more expensive at exactly the wrong moment before some of that loyalty starts walking out the door. The value brand that lost its reason to exist. Here's a different kind of decline, and arguably the most instructive one, because it comes down to a single strategic problem. One long-running Australian brand built its whole pitch around value, a solid, no-nonsense car, backed by capped price servicing and a long warranty, at a sharper price than the equivalent from a bigger-name rival. For years, that was a genuinely winning formula. Sales for this brand are down more than 20% in the first half of the year, and it's slipped in the rankings, passed by companies that didn't exist in this market a few years ago. The core issue is almost mathematically simple. If your entire identity is the affordable, well-equipped option, and a new competitor arrives offering more equipment, a longer warranty, and a lower price than you've lost the argument you were built on. It's not that the cars got worse. It's that somebody else took the exact playbook this brand invented and executed it more aggressively. The one model brand and the free fall brand. Two more stories worth separating out, because they represent opposite kinds of risk. The first is a household name resting almost its entire local business on a single vehicle, a Ute that's been a genuine runaway success, one of the best-selling vehicles in the country, full stop. Strip that one model out, and the rest of the lineup is a shadow of what the brand used to represent here, including a locally built icon that stopped production entirely years ago when local manufacturing ended. Overall sales for this brand slipped over the first half of the year, even while it clung to its ranking. And a wave of new Chinese-built Utes is now aiming directly at the exact segment, keeping it afloat, undercutting on price while adding more standard equipment. This isn't a brand about to vanish. It's a brand with almost no margin for error, betting its whole local position on one increasingly contested segment. The second story is the genuinely alarming one. A brand woven through Australian motoring history. Off-road icons, a Ute that raised generations of tradies. Family SUVs that sold in huge volumes for decades saw sales collapse by nearly 45% in the first 2 months of this year compared to the same period a year earlier. Individual model declines in that window ran as high as 70+%. New versions of its key models are on the way and should help. But this local collapse is happening against a genuinely troubling global backdrop, the parent company posting significant losses worldwide, cutting large numbers of jobs, and closing plants as it fights for its footing internationally. When a brand's local arm sheds nearly half its sales in a matter of months, that's not a local blip. It's the local face of a much bigger, much more serious global problem. One cause behind 6 different stories. Here's the question that actually connects everything above. Why is this happening to so many established, trusted brands at exactly the same time? 2 years ago, most Australians would have struggled to name a single Chinese car brand. Today, those brands are rewriting the market, and it's worth understanding the mechanics of how. The formula is consistent across nearly all of them. More standard equipment, longer warranties, and lower prices than the established competition. In a cost-of-living crunch, that combination is precisely what a financially stretched household is looking for. Several of these newer entrants have posted year-on-year growth in the hundreds of percent, moving from a standing start to genuine volume in a very short window. The part that makes the damage so severe for the older brands is this. The overall Australian new car market isn't really growing right now. It's roughly flat, even softening in places, in a climate where households are nervous about big purchases. That means this isn't new buyers being added to a growing pie. Every sale a new entrant wins is a sale taken directly from an established brand. To be fair, there's a genuine upside for buyers here. More competition, more equipment for the money, longer warranties, real value in a tough economic climate. But there's a catch worth taking seriously. Many of these newer brands are, by definition, new to Australia. Nobody yet knows how their vehicles will hold up after 5, 8, or 10 years of Australian sun, dust, and highway driving. Nobody knows how deep the parts and dealer network will run once the initial excitement settles. And critically, nobody yet knows how well these vehicles will hold their resale value over time. Early signs on some models suggest fairly steep depreciation. A cheap price today can turn into an expensive lesson at trade-in time. There's also a quieter issue sitting underneath the headline sales numbers. Dealers in several networks have flagged unsold stock building up faster than usual. Some of what looks like record delivery volume is simply months-old orders finally arriving, while genuine walk-in demand from cautious buyers softens underneath it. 3 things to check before you sign. So, what does this actually mean if you're about to buy? First, check the brand's trajectory before you fall for the car. A genuinely great vehicle from a brand that's shrinking quickly is still a risky long-term buy. You'll be the one chasing parts and watching resale value slide in a few years. Look at whether the brand is growing or shrinking here before you look at trim levels. Second, watch the dealer and service network, not just the showroom. This is the early warning sign almost nobody checks. When a brand comes under real pressure, dealerships quietly close, servicing gets less convenient, and warranty claims become a longer process. Ask how many dealers actually service your area right now, and whether that number has been shrinking. Third, be realistic about resale, especially if you're financing. The value of a car from a struggling legacy brand, or from a brand new to the country with zero track record, can fall faster than the finance figures assumed when your loan was written. That gap is exactly how people end up owing more than the car is worth. Treat confident resale promises from any brand on either side of this story with real caution. 6 very different brands, 6 very different reasons for the pressure they're under, but one shared cause sitting underneath almost all of it. And every one of these cars is still sitting in a showroom right now, being sold as if none of this is happening. The car you buy isn't just transport, it's tens of thousands of dollars parked in your driveway. Make sure the company behind the badge is still going to be standing strong by the time you're ready to sell it. Tell me in the comments which of these caught you off guard. Do you own one? And has resale or servicing already been harder than you expected? Your experience might be exactly the warning someone else watching needs to hear. If this was useful, send it to whoever's about to buy their next car. And subscribe, there's more of this coming.